Hello everyone, welcome to chapter 23. In this chapter, we will discuss standard deviations and how important they are if you want to accurately anticipate and predict expansions and reversals, and if you want to be able to have precise turtle soup entries. Till now, I never talked about standard deviations, and that was for a reason. But now I finally decided to share everything about standard deviation that there exist. What are the fundamentals, how to use it, and most importantly, how to use it to get precise entries and stop losses, and much more. So, without any further delay, let's get into the chapter. Now, to fully understand this concept, we first need to explore the concept of the mean, right? Which basically acts as the foundation for everything that we are about to discuss. And then we will connect that concept of the mean to standard deviations, which will helps us basically measure volatility and helps us identify key zones for potential reversals or expansions. Now, let's break it all down step by step. So first of all, we've got the mean, right, which is basically the market's balance point, right? The mean represent what we often call the fair value or the equilibrium price level, right? This is where the market tends to find balance and the buyers and sellers or the algorithm is in harmony, right? And the price stabilizes. Now think of the mean as the market's comfort zone, right? It's the point where the majority of orders accumulate and which essentially creates periods of consolidation. Now, examples of the mean are the Asian range, the CBDR or the central bank's dealer range, and the original consolidation of the market makers model, right? All of these are examples of the mean because price usually forms consolidation or ranging profile within these time periods or within these ranges. Now, the mean is critical and important because it's the price level where the market perceives balance, right? And when price moves away from the mean, it creates an imbalance. And we know that when price creates an imbalance, that's where opportunity for us arises, and that's where we can find potential trade ideas that can help us position ourselves in the direction of the higher time frame drawn liquidity, and then we can potentially exploit and capitalize on the range expansion that is about to occur. Now let's connect this to standard deviation, right? Now standard deviation basically measures how far price moves from its mean, which allows us to gauge or assess the market's volatility, right? When price is within the one standard deviation of the mean, it is basically in its normal range. That's what we call, right? In its normal range. But when price starts moving beyond two standard deviation, that's when things get interesting, right? Because beyond two standard deviation, this signals an overstretched market, right, where price is either overbought or oversold, right? And those zones can often provide us good areas for reversals, or maybe it signals the beginning of an expansion, right? And by understanding where price is in relation to these standard deviations levels, we can identify areas where the market is either ready to reverse and return to the mean, or it is poised for a continuation due to strong momentum. So now that we've discussed both the mean and standard deviation, let's now see and evaluate how does this work in practice. Now, when price stays close to the mean, it basically reflects low volatility and the markets are balanced and there's little movement. But as price starts deviating further from the mean, it signals that volatility is increasing and the market is basically entering a phase of an imbalance, right? Now, to sum it up, the mean is where the market finds balance, and standard deviation measure how far price deviates from that balance and how big of an imbalance it creates. And together they create a framework which helps us understand price action, helps us measure volatility, and not only that, but it also helps us find areas for potentially putting our entries and stop losses for turtle soup entries specifically. Moving on to the next slide. Here in this slide, we will talk about the importance of standard deviations. Let's talk about why standard deviations matter and how they can be a powerful tool for improving your decision making process, right? And in this chapter, I'm going to show you that these are not just numbers, but rather they are a roadmap or a guide for you to understanding price action, managing your risk, and setting precise targets and entries, right? Now let's go over their key uses step by step. Now, the first and the major importance of standard deviation is that it helps us identify high probability areas for reversals and expansions, right? Now, standard deviations are important for spotting key zones where prices either overstretch or about to expand. And based on the higher time frame framework and drawn liquidity, you could look for price to overextend in the counter direction of the mean. And then once it reaches an overextended standard deviation like the 2, 2.5 or 4 standard deviation, you can then look for reversals there, and there will be higher probability zones for you to expect reversal or anticipate expansions to occur. Number two, it helps us set stop losses and stop loss levels for turtle soup entries. Now, if you are using turtle soup entries, by analyzing how far price has deviated from the mean, you can set your stop loss level strategically just beyond areas where price manipulation or liquidity grabs could likely occur, right? And this ensures and makes sure that you are protected from unnecessary losses while allowing enough room for the trade to develop. Number three, standard deviations helps us measure the manipulation profile phases. It helps us understand the manipulation phase of the market, right? And we know that during this phase, price it basically moves sharply beyond the mean to grab liquidity before reversing or continuing in the opposite direction, right? And by measuring these deviations, you can anticipate and uh, predict when the manipulation is likely to end and when the true move is about to begin. Number four, it helps us predict the high or the low of the day, or even the high or the low of the week, right? One of the most practical uses of standard deviation uh, is its ability to predict the daily candle or the weekly candle high and low with the help of plotting out the standard deviation of the mean ranges. In terms of the daily candle, you can plot the standard deviation of the Asian range in the CBDR, and when they align at specific levels with the higher time frame key levels, you can anticipate and predict the lower high of the candle with extreme accuracy and precision. And in terms of the weekly candle, you can plot the standard deviation and take the Monday's candle range is the mean. Then last but not least, we've got setting precise targets, right? Standard deviations allows us to set precise take profit levels based on price relationship with the mean, right? And based on how far the manipulation profile is going to go and where our potential next target could be. Moving on to the next slide. Here in this slide, let's discuss some of the most important and significant standard deviations levels. Now, some of the key ones are listed here. They are the 1 standard deviation, the 2 standard deviation level, the 2.5, and then last but not least, the 4 standard deviation level or zone, right? Now, it doesn't mean that price will only react to these zones or levels and only these would work, but instead these are the high probability levels among the other ones. And if you could find a framework where these levels are on the table, then that makes that particular trade idea a high probability trade idea because of these levels, right? Sometimes that could react to other standard deviations level as well, right? But these one listed here are the most important one, and you should remember these when you are dealing with price action and understanding what's going on and what's happening. Moving on to the next slide. Here are some key important points you must remember with using standard deviations, right? These are basically the fundamental protocols, guidelines, or you could say the prerequisites for using standard deviation. So make sure they're always on point. First of all, we've got is that standard deviations must always be used in combination with key levels and PD arrays, and you must make sure that they are properly aligned with each other and they are integrated logically and accurately. Number two, standard deviation must align with key times of the day, right? And this basically ensures that standard deviations are in line with the market's natural rhythm during kill zones or key times or macros, which ensures high probability setups or trade ideas. For example, if the price is near a 2 or 2.5 standard deviation level at the start of the London kill zone, then you could potentially watch for a manipulation profile, which would then be followed by expansion in the direction of the higher time frame drawn liquidity or in the counter direction of the manipulation profile. Then the next point is the high time frame drawn liquidity. Now we know that it's the most critical aspect of our analysis, and you have to make sure that while integrating standard deviations, you need to make sure that you are only trading in the direction of the higher time frame drawn liquidity, and you're looking for standard deviations in the counter direction to expect a manipulation profile, and then look for trades in the direction of the higher time frame drawn liquidity. And you're going to make sure that all of your trades are aligned with the high time frame narrative, right? For example, if the liquidity is above, then look for buy setups near discount zone or after price rejects below the mean, either to a 2, 2.5 or 4 standard deviation level in a bullish direction, right? And if the liquidity is below us, then look for sell setups near premium zones or premium key levels after price rejects above the mean and reaches a standard deviation or a key standard deviation level, and then it expands or reverses in the bearish direction, right? Uh, Standard deviations basically helps us confirm where price might be overstretched or it might be poised to move towards the high time frame liquidity draw. Moving on to the next slide. Here in this slide, we will break down how to use standard deviations correctly within your trading strategy or system. And basically, I'll explain to you how you can actually align standard deviation in a step-by-step approach or methodical systematic approach with concepts, with key concepts like the mean, higher time frame key levels, and accurate timing to predict high probability reversals and expansions. Now let's finally talk about how to use standard deviations correctly. The first step is to identify the mean, right? This is basically your equilibrium or starting point for calculating standard deviations accurately. The mean can be based on either the Asian range, the central bank's dealer range or CBDR, or even a manipulation leg, right? A manipulation leg is basically a price swings in which price grabs liquidity and creates an imbalance which leads to forming a temporary mean. So you can use manipulation or Judas swing as mean as well, right? You're going to make sure to select the correct range to define your mean, right? And this will help you determine the accuracy of your standard deviation level. The second step is plot the different key standard deviations, right? Once the mean is identified, you're going to plot the key standard deviation levels around it, right? And these key levels will help you visualize how far prices move from equilibrium, and it will highlight areas where prices overstretch, right? Now you know that the key standard deviations levels are the 2, 2.5, and 4 standard deviation. And next up, you're going to compare your standard deviation levels with higher time frame key levels, such as a daily or 4-hour highs and lows, order blocks, breakers, or fair value gaps. And if a key standard deviation level aligns with a higher time frame key level, then this basically increases the probability of a significant price reaction. These areas often acts as magnet for price, which basically sets up potential reversals or expansion. Number four, wait for alignment at a key time, right? We know that timing is extremely critical and crucial, right? Even if the standard deviation level and high time frame key levels align, you must wait for the market to test this area or this zone during a key time for it to work accurately, right? And without the correct time or macro, it won't work, right? And let me say it again, even if you follow the other steps, right? And and all of the steps align with each other, but if the time isn't right, it won't work, right? Because remember, time over price, right? Time is more important than price. So once the key levels and the standard deviation levels are aligned with each other at the right time, you can then begin to predict or anticipate a reversal or an expansion to occur. And then for you to confirm your signal, you're going to look for confirmation such as price rejecting the level or reacting to that level with strong wicks or engulfing candles, or prices forming as an SMT divergence there, which shifts the order flow in the opposite direction and basically signals the potential of a reversal to occur. And then from here, you can anticipate a move back towards the drawn liquidity to set precise targets or take profit levels. Moving on, here in this slide, we'll talk about how to use standard deviations for turtle soup stop loss placement. Now we know that standard deviations are the most effective tool for setting tight yet logical stop loss level in turtle soup setups or trade ideas, right? We know that turtle soups are when price takes out liquidity or purchase a high time frame CRT or candle range, right? Basically, it's a manipulation move where price manipulates and takes out liquidity. And by using standard deviations, you make sure and ensure that your stop loss is placed just beyond the manipulation profile in phase, right? Or the manipulation level. And that way it makes sure that you avoid the unnecessary stops out, while also at the same time it leaves room for the trade to play out, right? And to make sure that all of this works out, first of all, we're going to make sure that we integrate our analysis with the higher time frame framework, right? For our stop loss to work optimally, it must align with the higher time frame framework that basically supports our entry, right? There must be a key level, a candle range, and the correct drawn liquidity and order flow. And by combining these factors with our standard deviation analysis, we ensure that our stop loss aligns with the broader market context. Now, let's dive into how to use standard deviations effectively for setting precise stop loss levels and turtle soup entries. Right? Here's the step-by-step breakdown. When executing a turtle soup entry, your stop loss placement is critical both for managing risk and optimizing the trade potential for a higher risk reward ratio, right? That's the main reason why we even use or prefer stop loss turtle soup entries, because of the immense and the extreme risk to reward ratio that it offers us. And standard deviations offers a precise and a logical framework for this to happen, right? You're going to consider the following elements when placing your stop loss. First of all, candle ranges or CRT. You're going to use higher time frame candle ranges such as the 4 hour or daily CRT. Then we've got higher time frame key levels, right? You're going to place your stop loss just beyond a significant higher time frame key level. And then last but not least, we've got order flow. You're going to make sure that the higher time frame order flow confirms your trade direction, right? And then by combining these factors with your standard deviation analysis, you will ensure that your stop loss aligns with the broader market context. Next up, standard deviation provides an objective measure for determining how far price might extend during a manipulation profile phase or move, right? And you just have to watch price and see how it's behaving around certain levels in certain standard deviation zones, and then you're going to match it with other zones and then potentially wait for a confirmation and then put in place your stop loss once a reversal or expansion is confirmed, right? Now, to summarize this whole step-by-step approach on how to set stop loss for turtle soup entries effectively, these are the 3 steps. First of all, use standard deviations is the foundation for placement, and you're going to focus on the 2, 2.5 and the 4 standard deviation levels for most setups. The second step is align the stop loss with the higher time frame framework such as candle ranges, key levels, and order flow. And then last but not least, ensure that the stop loss is placed just beyond the manipulation level to account for liquidity grab while avoiding unnecessary risk. These are the 3 steps you're going to make sure follow while setting and placing your stop loss for turtle soup entries effectively. Moving on to the next slide. Here in this slide, you can see this price action chart. And with this chart and price action, I'm going to explain to you how you can set and place precise and accurate entries and stop losses. First of all, right here, you can see the opening and closing times of the day with these dotted lines annotated on the chart. And then along with that, you can see this gray rectangle or box, which is our Asian range, and it's going to act as our mean, right? Mean is basically where the market is balanced. The next step we're going to do is to plot out our standard deviation level for this mean or this Asian range. And then along with that, we're going to do our higher time frame analysis and determine our higher time frame drawn liquidity and mark out a higher time frame key level. And by doing our higher time frame analysis, we've determined that our higher time frame drawn liquidity is higher and the directional bias is bullish. And we've got this 4-hour key level right here. You can see in this gray here, which price has to test before expanding higher. What you can see right here is that after the Asian session ended and it formed a ranging profile in this mean right here, During the London Open and New York zone, we had this expansion lower towards the key level to be tested before we could expand higher. And during New York zone, we formed this liquidity in the form of forming this low just above this key level. And then what happened at the end of the New York zone, which is basically a key macro for manipulation profile to occur, we had this turtle soup, right? And with this turtle soup, we tested the high time frame key level and reach the two standard deviation level of the Asian range and the mean, right, which also aligned with the high time frame key level. So your entry could have been refined to this high time frame key level or this two standard deviation level instead of taking it right away after the turtle soup happens, right, which would have basically given you a less precise entry with a lower risk reward ratio. But with this standard deviation analysis, you not only refined your entry, but also at the same time you can see that our stop loss would have been at this 2.5 standard deviation level, which is a protected zone because price is already extended enough to the standard deviation level, which aligns with the high time frame key level as well. And it all happened at a key time. And based on all of this context and framework, price is more likely to reverse explosively from there because of the strong reaction and narrative that we built. So our entry at the two standard deviation level combined with the high time frame key level would have been a precise entry, and we would have set and placed our stop loss at the protected 2.5 overextended standard deviation zone or level, which would have given us this precise entry. Now the reason why we would have set our and place our stop loss at the 2.5 standard deviation level is because price had already tested the two standard deviation zonal level, which also perfectly aligned with the higher time frame key level. And we also had a turtle soup, and all of this happened at a key time. And more likely than not, based on that framework and narrative, price is going to have a strong reaction from that key level instead of extending even more, right? This is basically an example of my turtle soup entries that I take. And now you can see exactly how am I able to put my stop loss and have such precise entries with such high risk to reward ratio, right? And you can see that based on this framework you could have had a precise entry at the extreme point possible, right? Now there are other details to it as well, which I won't share here, but this is one of the things that I take and consider in my analysis. Moving on to the next slide. Here in this slide we've got this another example right here. You can see again we have the opening and closing times represented by these dotted lines, and right here in this gray area we have the Asian range. So what we've done is we've plotted out the standard deviation levels of this Asian range. We've got the 1 standard deviation level, the 2 and 2.5, and then along with that you can also see this high time frame key level in the form of this high right here, and it perfectly coincides and aligns with this 1 standard deviation level of this Asian range, which is our mean. What you can see is that during the London open kill zone we didn't do anything significant at all, and we just accumulated and generated more liquidity below that key level and below the 1 standard deviation level. And then during New York kill zone at key time when we had that news event, what we did is we took out the liquidity above the London open kill zone. We took out that high time frame key level in the form of taking out that high, basically meaning that we reached the high time frame key level, and it all perfectly aligned with this 1 standard deviation level, right? And it all happened at a key time. So our entry would have been after this high time frame key level was taken out, or this high was taken out, or maybe our entry would have been at the 1 standard deviation level, and just above you can see the 2 standard deviation level, which would have been protected zone for us because price might not extend that higher, and that would have been a high probability area for us to place our stop loss, and we would have had a precise and refined entry, right? So basically our entry would have been after this high was taken, and our stop loss would have been at this 2 standard deviation level, right? And then we would have had this high risk to reward ratio entry. This is basically how you combine your standard deviation lower time frame analysis with your high time frame broader market context and framework, which makes you capable of having such precise and refined entries. So now that we've discussed that, let's move on to the next slide. And here in this slide, we're going to break down how to anticipate the high or the low of the day or the daily candle using standard deviations. Now, standard deviations are an excellent tool for predicting where the high or the low of the day might form. The one or the two standard deviation levels relative to the Asian range are where the high or the low of the day typically develops, right? Not always will be the high or the low of the day be formed at these levels, but if you can align them with the correct framework at such levels, it increases your odds and probability and and chances of predicting it accurately, right? In some cases, the high or the low of the day might also extend to the 2.5 standard deviation level. And to increase the precision of your prediction, you're going to align the standard deviation analysis with the higher time frame, broader market context, and higher time frame key levels. And the higher the low of the day typically forms during these specific times of the day, such as the London open kill zone and New York open kill zone. And to basically improve this accuracy, you're going to wait for price to test the aligned standard deviation in higher time frame key level during key times such as 3 a.m., 9 a.m., 11 a.m., and so on. And this is how you're going to be able to predict the high or the low of the daily candle. Now let's move on and let me explain some examples to you. So here in this slide, you can see again this price action chart. We have the opening and closing times. We also have this previous day high, which is basically our candle range high. And right here in this gray box, we've got the Asian range, which is our mean. What we've done is we plotted out the standard deviation level, and you can see that the 2 and 2.5 standard deviation level perfectly aligns with the previous daily candles high or the previous candle range, right? And what happened is that during the New York kill zone, during the London kill zone and London lunch, we formed these equal highs just below this high time frame key level in this daily candle range high. And then during New York kill zone at 9 a.m. key time and key macro, what we did is we took out that high and also tested the 2.5 and reach and extended to the 2.5 standard deviation level of the Asian range. And you know that's a high probability area for price to reverse from, right? And that's where you can accurately predict your high of the day. And you can see once we reach that 2.5 standard deviation level and took out the daily candle range high, right, that basically aligned with the whole framework, and we formed the daily high of the candle there. And that could have been where you would have taken your entry, and then you would have set your stop loss at the 3 standard deviation level or maybe the 4. And you can see that after that happened, price reversed lower and from you have the candle there, right, and a reversal happened. That's how you accurately predict and anticipate the high of the daily candle to be formed. Moving on, here we've got another example right here. You can see that we have this high right here. In the beginning of this chapter, I told you that you can also use manipulation leg or legs where price takes out liquidity, because they also form temporary means or temporary protectionally legs which can be used to plot out the standard deviation level and accurately predict high or low of the day. So what you can see is price took out this high, which is basically our manipulation leg. What I did is plotted out the manipulation, the standard deviation of this manipulation leg, and right here you can see is that once price reached the 2.5 standard deviation level and had this turtle soup, we formed the low of the candle there, the low of the day there, and then we expanded and reversed from there. Now let's move on to the next slide and let's discuss another example. So right here again you can see the opening and closing times. We've got the Asian range, which is our mean, and what we've done is we plotted out the standard deviation levels and our higher time frame key level. Our higher time frame drawn liquidity and directional bias is lower and bearish, so what we're going to do is we're going to look for bearish trade ideas, and to support those bearish trade ideas we have this higher time frame key level right here just above this one standard deviation level. What we did is during New York kill zone, we formed this high just below the high time frame key level, which means that we generated liquidity. And then during the London close kill zone, what we did is we took out that high, had a turtle soup, and with that turtle soup we tested the high time frame key level, and that high time frame key level perfectly aligned with the 1 standard deviation level or the 1.5 standard deviation level of this Asian range. right? And that's where you could have taken your entry, and that would have given you a precise entry. And for setting your stop loss, you would have used the 2 standard deviation level, because that's an overextended area where price might not be able to extend that much, because we've already tested a high time frame key level, we've already reached 1 standard deviation level, and we have a turtle soup, and that all of that happened at a key time. So more often than not, we're going to reverse from there explosively and expand lower, right? And that 2 standard deviation level would have been a high probability area for you to put your stop loss, which would have given enough room for trade to play out by. So at the same time, it would have given you a precise entry, and your entry would have been at this higher time frame keyword, or maybe at the 1 standard deviation level. And instead of taking an entry right away right here, which would have given you a lower risk to reward ratio entry, you would have set your entry at this key level, which would have given you a better entry in terms of risk to reward ratio. This is how you set precise entries and stop losses, and this is how you basically predict and anticipate the high or the low of the day to be formed using standard deviation analysis. And now you can see right here how important our standard deviation analysis is in our strategy and system, and how you could actually use it in the correct way, right? This is how you use it.